Hi there, welcome to Kneppy Invest and welcome to another answer and reply video. I am recording this video a little bit earlier than I usually do. I usually record this video on a Saturday morning, about 10 a.m., then release it on a Saturday afternoon or evening. But I decided to record this video on Friday afternoon. Current time is 2:25 p.m. The whole reason I am doing that is because I have planned a fairly long hike tomorrow on Saturday. I plan to start at about 6 a.m., finish roughly about 3, so maybe an hour on either side of that. So we are talking about 9 hours of hiking. There are reasons behind me doing this. And, well, the whole reason I'm doing this is so I can just see how my body can handle, because I went for a long run today, 21 kilometers today running, another 2 kilometers walking. And I just want to see how my body can handle 2 pretty full-on days. Because I'll be doing that a couple of times on my holiday in September and October. I have a feeling I'll be okay. I've done this before. I do have a feeling I'll be okay. And the other reason I'm doing this is because this hike is about 37 kilometers. My longest planned hike in the United States is going to be, or Canada, is going to be 39 kilometers. And I'm not sure I can complete that in a day. So this will be a nice little test whether I complete not 39 kilometer hike in one day, even though this hike is going to be a little bit shorter. I just want to see if I can do it. And the other thing is the elevation in this particular hike will be larger than that really long hike. And funny enough, that long hike will be my second hike on that trip. Now, a couple of questions or comments in regards to my hike tomorrow, or just on hiking in general. Rick Thelen says, just on hiking, wouldn't feet above sea level thinner air? Yes, as you go up from sea level to high altitudes, air does thin because the pressure becomes less and less. Pressure is just the weight of air above you. So as you go up, there's less air, so it becomes thinner and thinner. And that is why some people get altitude sickness when they go living or existing at sea level and decide to climb up a really large mountain. So it's also a reason why you have to adjust if you want to climb Mount Everest. You have to adjust. It takes a long time to adjust. And I have experienced altitude sickness. I've seen people being affected by altitude sickness, and you do have to adjust. So I am planning for that. In fact, my very first hike is acclimatizing hike. So I'll be staying at about 9,000 feet, hiking up to about 10,000 feet. So I can acclimatize to the hikes I'm going to do after that. So absolutely true. Air does thin as you go up, and it can cause problems. It's also why athletes sometimes decide to train at high altitudes, because air is thinner at those levels, and your breathing, your lungs become more efficient if you train at higher altitudes. Now, Igor 51987, where will you do your 2,000 meter elevation gain hike? So this is a really good question, because I am planning a hike tomorrow, or my hike I have planned tomorrow has about 2,000 meters of elevation gain. That's not in one go, because that's an almost impossibility in Australia. So I'm not going from sea level up to 2,000 meters, because again, Mount Kosciuszko, that mountain, tallest mountain in Australia, has a height of 2,200 meters, or about 7,000 feet. So that's an impossibility that I could do that in one go. So what I decided to do is find a hiking area where there's going to be a lot of valleys and ridges or mountains, that sort of thing. And near me, there is a perfect area to do that. What's it called? The Aguilar National Park. I cannot ever pronounce that. And in fact, I have put that particular hike into All Trails and also Strava. There's slight differences between the two. So in Strava, it says elevation gain is 1,981 meters and 37 kilometers. And in All Trails, it's 38 kilometers with 1,877 meters of elevation gain. And the reason I can get 2,000 or almost 2,000 meters of elevation gain, and I'm going to get 2,000 meters if I get near my car at the end of the hike and I'm not quite at 2,000 meters, I'll go up a little bit, because where I'm parking It's right near a mountain called Camp Mountain, and there's a nice little elevation gain. So if I'm very close to 2,000 meters, not quite there, I'll just go up a little bit to get that 2,000 meters. And if we go to Strava, it does look much better on Strava. You can see there's a lot of valleys. So in the middle of this particular national park, there's, I think, at least one valley. There could be two valleys, and then there's ridges on top. So when I go from one ridge to the next ridge, it means I have to go down the valley, and I do that twice. And that is how I'm getting a lot of elevation gain, 2,000 meters of elevation gain. So in a way, I'm almost climbing from sea level to Mount Kosciuszko, almost, but not quite. And the other interesting thing is, just think about this. Mount Kosciuszko has an elevation of 7,000 feet, and the mountain I'll be climbing, that really tough climb, the hardest hike in the United States, that goes from almost sea level to an elevation of 11,000 feet. So those mountains absolutely dwarf our tallest mountain. And in Colorado, they have many, many 14,000 foot mountains. And in fact, the first time I went to Colorado, I discovered they have a 14er club, those who try to climb all the 14,000 mountains in Colorado. I'll be doing 5, or I'm planning to do 5 this particular trip. So again, just think about that. These mountains are 14,000 feet, and there's about 50, I think. And the tallest mountain in Australia is 7,000 feet. So twice the tallest mountain in Australia. So thank you for that question, Igor. Now let's go back 5 days ago. And if you have any more questions about my hike, glad to give those questions. I have to figure out why these two hikes are different. I thought they're exactly the same, but the distance is slightly different. I'll follow Strava because that's slightly lower, and elevation gain is slightly higher as well. So I'll follow Strava. I can put the hikes into my watch, and I also can have a look at my phone. It's very important that you do that. Okay, let's go back 5 days ago, because Sensei says something very important here. Always remember that we each only have 7,000 usable minutes in a week. Only 7,000 usable minutes in a week. While awake, usually we are fast asleep for 3,080 minutes a week. Always make sure to double trip times, question yourself about what you spend each of precious minute on. It's funny enough, it's one of the reasons why I just don't like sleeping, because in a way it's wasted time. I understand we have to sleep, but if I didn't have to sleep, I wouldn't do it, because in a way I think it's wasted time. I just don't understand. And I know I'm being a little bit ignorant or maybe intolerant. I just don't understand why people love sleeping, because you're not doing anything. Anyway, that's just me. But it's very important to note, it's very important to efficiently use your time to the best of your ability, do whatever you want to do, make money or enjoy yourself, that sort of thing. It's a balance, work-life balance, very important. So thank you for that, Sensei, for reminding us that very important very important thing. Trader Hooper says, I wouldn't mind a video on analyzing 4Cs and analyzing 4Ds. I know I can work this out from other videos, but wouldn't mind a standalone video on the topic. I think I can do that. I think I can do that if I don't forget. I should write this down, because I will forget. Analyzing 4Cs and analyzing 4Ds. I won't do it in this video because it'll take a little bit too long, but very good topic for one of those banked videos that I will be starting to record soon. Anyway, so hopefully useful to others who also don't have a financial background, perhaps a topic to cover in your banked videos. Exactly. So there are subtle differences between the two. Well, there's not so subtle differences between the two. One is released every quarter, one is released every half year. Although, is 4D just a half year? Or does that include the half year and full year? I can't remember. I might learn something as well. Josh Tim, Supply Network, what is Kneppy's opinion on this ASX stock? Business model operating under the Multispares brand. The company offers extensive range of truck and business components, complemented by services, etc., etc. Going through the history, founder. Okay. So Supply Network. This is easy because I'm a shareholder of Supply Network. I would consider Supply Network to be high quality. So let's go through why I would consider Supply Network to be high quality. And you can also cheat by just having a look at the chart, which I'll do in a second. So Supply Network was a company I've been following maybe 8 years ago, maybe even longer than that. Can't remember why or when. And at that point in time, whether this company was high quality is probably questionable, probably needed a little bit more proof. But definitely over the last 5 years, I think this company has provided us enough evidence to suggest it is definitely high quality. So Supply Network share price is just above $40. I bought it 30, and I thought when I bought it 30, because I was waiting for a really good pullback in the Supply Network share price, and it never happened. Never happened over a long period of time. And when it got to 30, I just went, I'm just going to buy some shares at 30. And if we do get that really big pullback, I'll buy some more shares there. And we haven't seen a massive pullback. In fact, the share price has gone up 33% since then. Now, first thing I always look at is revenue growth, and then I turn my attention to earnings per share growth. Now, I do prefer revenue per share growth, but I don't think this company would have increased their shares on issue or even decreased the shares on issue. Let's have a look. No, they've slightly increased the shares on issue over the last 10 years from 40.8 million to 43 million. So I think we can look or focused on revenue growth. So if we do that, revenue has been growing. In fact, revenue has been accelerating over the last 3 to 5 years. Over the last 10 years, up 14.7%, 20% in the last 5 years, 22.1% in the last 3 years. And we've seen that flow through to the earnings per share growth. 10 years, 18%, 32% over the last 5 years, 28% over the last 3 years. So spectacular growth in this company's earnings and revenue over the last 3, 5, and 10 years. So that is a clue that things are moving in a good direction for this company. Now, I don't know if this company has been overly acquisitive. I don't think so. So a lot of this would be organic growth. Next thing I look at is margins. Gross margins 43.6%. That's pretty good, okay, for this type of business. Operating margins are 16.9%. Now, what I also like to see when it comes to margins, any sort of margins, is I don't want to see margins decreasing through time. Now, 10 years ago, it looked like maybe margins were decreasing, but over the last 5 or 6 years, margins have increased. This is gross margins. But to be honest with you, they've ranged between 41.5% at the low and 43.6% at the high. So that means there's not much of a decrease or increase in gross profit margins. The other thing I like to look at is operating margins here. I would assume this has been going up. Yeah. So this has been going up. So this company has become more efficient and it's good. So from 8% at a low in 2016 up to 16.9%. Whether the company can keep on growing their operating margins remains to be seen, but that's a good sign that this company, found some leverage. Okay, so nice margins, no complaints with margins, also operating margins increasing through time. Next thing I look at is return on equity, return on invested capital. So return on equity 31%, return on invested capital 22.6%. This is a 5-year average, and I'll also like to look at any sort of shift or change in these quality metrics or capital efficiency metrics as it's called in FinChat. So return on equity and return on invested capital, they've actually been increasing through time. So that's another good sign. That's another good sign that the company is becoming, in a way, better, more efficient. Capital efficiency, more efficient. So back in 2015, the return on equity and return on invested capital around about 20 to 23%. Now they have grown to 36% for return on equity and up to 27% for return on invested capital. So that's another good sign that this company is becoming better. It's going from maybe quasi high quality back 10 years ago, if that, now to definitely a company you could say is high quality. Now, the one thing I'll just mention right here is because the perception of this company has suddenly changed over the last 10 years from questioning whether it's a high quality company to now saying, well, this is definitely a high quality company in my opinion. Because of that change in perception, the market is willing to pay more of a premium for this company. So the P ratio of Supply Network has gone up significantly over the last 10 years. So right now, according to FinChat, it's 46.3. Now, if you have a look at the history of the P ratio and go back 10 years, So in 2015, P ratio was 13. Now it's 46. And you can just see this going up through time. So this is what we call margin, no, not margin, multiple expansion. The market is more and more willing to pay a premium. Now this could end soon or could keep on going for another 5 years. Now, I'd become a little bit more nervous if we continue to see the P ratio go up, sort of like what's happening with CBA. CBA P ratio is at 30, and I just can't imagine the P ratio of CBA going any further than any higher than 30 because that's just insanity. This company is a little bit different because it's growing. CBA is not growing. So this company deserves definitely a better, higher P ratio than CBA. But the question is the P ratio right now a little bit too stretched? Wasn't that long ago, the P ratio for this company was between 20 and 25. So we have definitely seen a bit of premium priced into this company's valuation right now. Now, another way you can just tell whether a company is high quality or not is just, you notice I'm not talking about management, not talking about moats, that sort of thing. Now, I did actually question ChatGPT about Supply Network versus another company in America, and it gave me a really good understanding on why Supply Network is growing. See if I can actually, I think there is, I'm pretty sure there is a search function in ChatGPT. Let's have a look. Supply Network. Oh, in fact, I'm right on it. Here it is. So I did many, where is it? So I compared two companies, Fastenal and Supply Network, compared the two companies, not countries. Similar financial metrics, i.e. margins, return equity, dividend payout ratio, but Supply Network is growing revenue and earnings at a much quicker rate. So these companies are fairly similar, except Fastenal is pretty big, but the revenue and earnings for Supply Network were dwarfing Fastenal, even though they had a fairly similar P ratio. And ChatGPT went through and gave me some really good answers. Like, for instance, niche focus versus broad market, scale versus expansion phase, operating leverage, which I've already talked about, different competitive pressures, management strategy, market tailwinds. Anyway, so that's why Supply Network is in a growth phase right now. But if it becomes bigger and bigger, I think maybe it will turn into Fastenal. Possibly, if it becomes bigger and bigger. Anyway, sometimes you can just realize the quality of a company just by looking at the long-term chart. So if we turn our attention to the weekly chart and look at the 200-week moving average, the share price of Supply Network has been above this average since 2010. A couple of times has touched this average during the COVID-19 financial panic, and also touched this particular moving average back in 2016. Those were great times to buy. But just before that period or that time when the share price hit that moving average, share price was struggling or not doing much. So back in 2016, share price went sideways for about 2 years. And maybe even the same was true in 2020. The share price went sideways for 2 years. So don't be surprised if you see the share price of this company go sideways for a long period of time. And the reason behind that is because sometimes you'll see the share price rally and then go sideways, consolidate. And that's actually quite healthy. Now, probably my big concern about Supply Network, I've already mentioned it, share price right now is well above the 200-week moving average. So right now we're talking about $20 above it. So 200-week moving average is at $20. Share price is above 40. So that means there is potential. The share price could fall a fair bit because we have seen a fairly rapid period where the share price has just expanded and the multiples have expanded as well. P ratio up to about 46 or so. So share price keeps on going up, but I would not be surprised to see a long period where either share price does nothing or pulls back significantly. Now, we did see the share price pull back. This is the daily chart now. So this is the 200-day moving average. And remember, on the 7th of April, that was a low, and the share price of Supply Network has gone up 33% since then. But if you do have a look at this daily chart, it's still looking pretty good. No complaints about this at all. So that's my thoughts on Supply Network. Just in terms of quality, now haven't talked about the management, that sort of thing. So I think the reason I'm doing that is management. Your opinion of management can be more subjective or objective, whatever word I'm thinking there. It's your opinion. It can be opinions. So that's objective, subjective, yeah, subjective. Looking at those numbers, you can't debate those numbers I just showed you. Those are more objective. Yeah. Anyway, so supply network, it's in my portfolio, in my long-term portfolio, high quality portfolio. So I have no problems about that particular company at all. I like it, just valuation. So sometimes you, I wouldn't say you can I suppose you can overpay. Just because a company's high quality doesn't mean you can buy it at any time. Sometimes high quality companies can be way overvalued, and sometimes the share price will go sideways for a long period of time. Hello, Microsoft, between 2000 and 2015, share price did nothing for 15 years. Okay, Ben Hutchison, talking about some buys he's made. Other than Alternate, a couple of stocks got to mention today that I was buying out of the bargain bin during the April lows. Step one, in Johns Lyng Group. I'm not confident in my ability to read sentiment, pick supports, top bottoms, all that TA stuff. So I tend to focus on scooping decent businesses when out of favor than being patient. I do like that. That's sort of what I used to do mostly, if not completely, is just look at value. But I have transitioned more. I still do that. I still look at a company and I think, oh, this looks really cheap, so I might buy some. That can be dangerous because sometimes a company is looking cheap for a reason, but sometimes it's just short-term hiccups or maybe medium-term hiccups. Sort of like Johns Lyng Group. It's just because there's a lower amount of natural disasters than usually are, and that does affect that company negatively. But who knows what's going to happen in the next few years? We could see an explosion in natural disasters, and Johns Lyng Group will do really well. And now's the time to buy that company. I don't know why Step One is struggling. Their chart right now is struggling, but the company does look cheap. I think no. Scott also says fair income, deep value. Oh, that's right. One of the other reasons why I want to discuss this is because Scott mentioned Tobias Carlisle. Fair income, deep value, as described by Tobias Carlisle, is interesting too, being enterprise value over operating earnings, which goes a long way, especially considering earnings growth and inflection. Now, yeah, Tobias Carlisle is a value play. He's a multiple acquirer. He's Australian, by the way. He's a Queenslander, pretty sure. Acquirer. He's not from acquirer. Can't even spell it. A multiple acquirer. The acquires. Oh, it's called the acquires multiple. Sorry, I got that mixed up. Anyway, so it's all about value. Now, I get emails from this every week, and they do actually do a DCF on a pretty big company. And my problem with their DCFs is they always really underestimate the potential of cash flow for these big companies. The most recent one wasn't NVIDIA. Which one was it? Oh, it was one of the big growing companies, and their growth forecasts were way too low, way too low. It was like 5% per year over the next 10 years. That's way too low. So very much value oriented. Tobias Carlisle. He also has a few ETFs, if I remember correctly, or a few funds at least. Anyway, so I used to listen. He has a podcast every week. I used to listen to his podcast every week, but I'm swamped with podcasts, and I have to decide, have to pick and choose what to listen to. Big boy baby. Check out Nasdaq NBIS for another data center play. NBIS. So whenever I get a company I've never heard of before, Nebius Group, NV, and I would assume this company is not yet profitable. They're just spending money to build out their infrastructure. Markup is 9 billion, enterprise value 7.74 billion. So they have more cash than debt. That's interesting in itself. I would assume most of these sort of data center companies have I wouldn't say heavily debted, but have a fair bit of debt. I'm just going to confirm that with NextDC. I'm just making an assumption here. Sometimes our assumptions can be completely wrong. So I'm assuming NextDC has a fair bit of debt. Well, not a lot, not as much as I thought they would. They do a lot of capital raisings though, NextDC. So that's how they are able to fund their infrastructure build out. Anyway, okay, so look at that chart. No revenue. What's happening? Revenue's been going backwards. Earnings per share, nice increase over the last 3, 5, 10 years. There's a lot of things that are screaming out. This does look like a data center, just like very little return equity, return invested capital. Your revenue, for some reason, is going backwards, but earnings per share are going upwards. No P ratio, it's actually negative. So it's telling me that the company is, what happened here? Why did the revenue go from 4.8 billion down to 13.5 million? What happened there? So that in itself is really interesting. And you can't even look at income or earnings per share growth, because if you have a look at earnings per share growth, it's all over the place. It's all over the place. In fact, there was one year when they had no revenue, they had a profit. They must have sold something. Let's have a look. I'm going to Google this. What did Nebius Group sell back? What year was that? In 2022. What did they sell? 2022. Might have been 2021. Let's have a look. I'm assuming they maybe Okay, here we go. 2022, Nebius Group reported annual revenue of 13.5 million, significant decline from 4.75 billion. This sharp decrease is attributed to the company's restructuring efforts, including the divestments of its Russia-based businesses completed in July 2024. Okay, so prior to this divestment, revenue streams encompass various sectors such as e-commerce, mobility, delivery, research, portal services, entertainment, and classifieds. This strategic shift has positioned Nebius Group as a significant player in the AI infrastructure sector, with plans to invest over $1 billion into AI infrastructure in Europe by mid-2025. So that's probably why they also have a fair bit of cash, because they divested, looks like a lot of their Russia-based businesses. Seems like they were completely Russian-based, based off how much revenue went down. Let's just have a look at the chart for this particular company, NBIS. And that's the daily chart, weekly chart. You can see a massive drop, $88 down to $16. Share price sort of all over the place over the last few months. Oh, looks like they weren't trading for a long period of time. If you go back to the daily chart, one of the problems with TradingView is when a company doesn't trade for a long time, you don't have a big gap there. You do see a gap in ComSec. So for instance, right here, if you can see my mouse right there, that's the 23rd of February, 2022, and looks like they were trading the next day, but the next day was the 24th of February. No, wait there. Or where's the gap? I'm trying to find the gap. It was just after that. Yeah, so 25th of February 2022, and then we have another candlestick right next to that, which is the 21st of October 2024. So that's their divestment. And the share price has increased since then. So if you just look at the daily chart, we'll have a focus on the daily chart. So I'm just going to use technical analysis here. We've just had a moving average crossover and a fair bit of volatility. So maybe one on your watch list. Maybe. Market cap $9 billion. Thank you for that, big boy baby. Yes, NBIS. Okay, to Bob. Hi, Kneppy. Thanks for another great video. Have learned so much from following your channel. Was wondering if you have made any videos on exit strategies. No, I don't. I would say exiting a position is maybe the most difficult decision you can do. And I always believe you need a strategy for every single position, why you bought and why you would set out, that sort of thing. So have an exit strategy on hand as soon as you buy. Why would you sell out? So to understand why you might sell out, you have to understand why you bought in the first place. So for me, for instance, I might have bought in because it looks like the share price is moving into an uptrend, and then if it goes against me, I'll sell out. Or, for instance, if I think a company is high quality, I bought in because A, company is moving in the right direction, a nice growth, a nice return on equity, return on invested capital, that sort of thing. Maybe they have 5-year goals and I like that sort of thing. And then if I see something change, or if I see some financial metrics start to turn a little bit more negative, that's when I might sell out of a high quality position. So it all depends on why you bought into a position. Anyway, so in my opinion, understanding when to exit a position or exit a company, sell out of a company, is probably the hardest thing to do. It's much easier to buy. I think I have heard you say you don't use trailing stops. If not, what methodology do you use for exiting trades? Love to hear your thoughts on this. Don't use automatic trailing stops. So I don't use stop losses. I don't put stop losses into the system because I want to decide when to sell out of a position myself. So I always have a look at all the trades I've made. Currently, I have about 25 trades. I always look at those trades every single day. And on occasion, a share price will fall below my trailing stop, but I won't automatically sell. I might just wait because sometimes you'll see the share price fall and then rally. I see that a lot. So I don't use automatic trailing stops, but I do use them. For instance, we can show you like this. We can show you right now. So this is my technological portfolio. So Stealth Group. So my trailing stop right now is about 63 cents. I probably will raise that. I probably will raise that to maybe... No, I might just leave it there. I want to be a little bit conservative with this one because I have taken profits with Stealth Group. Not complete profits, but share price is in a beautiful uptrend. But a lot of volatility since about March. A lot of volatility anyway. Shape Australia, another one, share price going up, and this orange line is my stop loss. And again, I raise these every so often, and all I'm looking for here is any sort of level where if I think the share price falls below, the share price might be struggling. Now here's one with Genus Plus. So I've got the stop loss. I probably put this in, I don't know, I'm not sure when I put this in, but the share price did fall below this level a few times and I did not sell. And you can actually see the share price rallying every single time it fell below 250. So we have 1, 2, 3, 4, 5 times share price rallied. So this is exactly why I don't put automatic stop losses, because you can just see what happens with this one. Now, some might say, well, I put my stop losses too high. I should put it down a little bit lower. That could be true, but I like to be not that conservative. The other good one was SKS Technologies. Very close to selling this one out because share price the chart was looking a little bit worse. Share price struggling, fell below my stop loss or trailing loss a few times. Share price down today though. And then the company released something good yesterday, but still, because the share price has been higher for a fair bit of time, share price is struggling to go on a run right now because the mindset of a lot of investors is if the share price doesn't increase from when they bought, it's a dog stock and they want to get out when they see the share price rise. So a few other instances. Catapult is another one. So Catapult also fell below my stop loss during that really bad period in early April. Fell below for 3 days, and I was just thinking, oh, not yet. I'll just be a little bit more patient with this one. And the share price has gone up, has almost doubled since then, which is insanity. So this is exactly why, and hopefully you can see why I put the stop loss there, because the share price went on a really good run back in November, and then we saw the share price hit about 320 a couple of times. That was a nice little support level, and then it fell through and then took off again. So that's how I decide to exit trading stocks or trading positions. So I just put in that orange line, and every single day I look at it. Where does the company share price currently fit in or compare to where that orange line is? If the share price is well above the orange line, sometimes I might be thinking, should I raise my stop loss? Should I raise? Because that's a really good thing. Keep on raising. It means the share price is still going up. And sometimes I have to make a decision. Should I sell? Should I not? But I don't want the share price to fall below that orange line for a long period of time because that would be going against my rules to sell out of those sort of positions. And sometimes, particularly for new buyers, what's a new buy I've made? Let's have a look-see. Kelsian. Let's have a look at Kelsian. So I bought Kelsian on this little rise on the 7th of May. So I haven't put the orange line just yet. So for the newer buys, I just have a 10%. Share price falls 10%, or sometimes it's just more of a feel. Share price falls 10%, just sell out. And because if the share price is falling 10%, there's more than likely that my original thinking, my original thesis for buying in has failed. has failed. So those are my trading, or how I decided to sell out of my trading positions. When it comes to high quality companies, I've made a bit of a change in how I deal with my high quality company. So up until maybe a year ago, I would sell out completely if I thought a company was overvalued. That was JB Hi-Fi. Last time I did that was JB Hi-Fi, and that was at $80. And JB Hi-Fi share price is higher than that. So even though I do think JB Hi-Fi is overvalued, the market is remaining irrational, and the company has grown a little bit since then. So what I've decided to do now is, instead of selling out completely, if I do think a company might be a little bit, not a little bit, but significantly overvalued, I'll sell out a portion of the company and just keep on the rest of it just for the longer term. And then if I see a value in a company that's in my long-term portfolio, so really good value, I actually add to my position. So the way I'm looking at it is, long-term positions, when they're overvalued, I'll lighten my position. And when I see really good value, I'll build up my position in those companies, because over time, if they are high-quality companies, the share price should keep on going up. That's the definition of a high-quality company. They become bigger and bigger and bigger and bigger. All right, so thank you for that. Hopefully I've helped you. Okay, I've already answered that one. Archie McCall, take a look at United Health Group, UNK. There's also United Health in USA. Not often a company with a $250 billion market cap crashes 50% in a month. Oh, you are talking about, for some reason, I thought you were talking about United Health Group UK, United Kingdom. So you are talking about UN, is it H? Yes, United Health Group. I'm assuming this is what you're talking about. Now, the share price of this company did drop a lot. Yes, it has dropped a lot. Oh, it has dropped a lot. Jeez. So I'm assuming you're talking about this company. Share price has dropped. Oh, why? Why is there no total there? Did I use the wrong one? I must have used the wrong one. Here we go. Share price has dropped 60%. This was a big, that still is a big company, $269 billion market cap. So you must be talking about that company. Yeah, it must be that company. Now, I probably would have considered United Health to be probably a high quality company, and share price has just gone bonkers. Yeah, so if you just ignore what's happened recently, the last month, if you have a look at the weekly chart, yeah, so since 2010, share price has been generally above the 200-week moving average. Now, back in the GFC, share price did fall a fair bit below it, but that's probably true for a lot of high-quality companies. But yeah, the share price has just tanked. And look at the volume. Look at the volume, massive volume coming in. Now, if you have a look at, I'll get into why. I did actually have a look at this when they first did go down, but I forget why the share price has decreased. It probably is on the back of some negative results. So if you have a look at the metrics of this company, so this is what I did with United Health at one point. I just brought this particular page up. Revenue growth, about 10% per year. So between 10 and 12% per year. So this company is growing at a nice rate for this size over a 3, 5, and 10-year period. Earnings per share, around about 10% as well per year. It's pretty nice. I don't care about dividends. So dividend yield is actually quite nice for a USA company, 2.2%. Operating margins, 8.2%. Gross margin, 22%. It's a healthcare company. I'm pretty sure they provide insurance, that sort of thing. They probably provide other things as well. I wouldn't expect that high gross margins and operating margins. I'd like to compare that to, say, other similar companies, whether that's high or not. I actually don't know. They do have a fair bit of debt. We're talking about $50 billion of debt. So it's a fair bit of debt, but the debt equity is still 0.8. Return invested capital, 21.3. Return on equity, 21.3. Return on invested capital, 10.4. So return on equity is nice. Return on invested capital is getting about 10%. I don't want to see return on invested capital getting low, any much more below 10%. And then the P/E ratio. So when I looked at this, I forget when, the P/E ratio was like 30 to 40, and I was thinking, no, not for me. P ratio right now is 12.7, but there's a reason behind that. And I am just going to cheat and just ask ChatGPT, why has United Health share price dropped 60%? I do remember reading this month and a bit ago. So, well, it's giving me more reasons than I would have. Yeah, this is the reason. Point 2, earnings miss and guidance withdrawal. That is I suppose, the catalyst for the share price starting to drop. And I still remember that. Yeah, earnings miss and guidance withdrawal. So that's pretty big. Earnings miss and then withdrawing guidance. Not sure why. And then because that happened, all the analysis downgrade the company. And why would they downgrade it? Well, because they have their algorithms or their machines, whatever, and they put all the numbers into their algorithm to spit out a fair value of the company. And if the company misses earnings and they withdraw guidance, and then the analyst has to do some more work, what do they think the numbers are going to be for the year or for the next year? And you might get a wide range of variables at play, wide range of different numbers. You put that into your machine and it spits out a much lower fair value. So for instance, HSBC downgraded to reduce and lowers its price target from 490 to 270. Current price is 297, reflecting concerns of the company's exposure to regulatory risk and rising medical costs. So maybe if Trump is doing good things with the healthcare system over there, and he will reduce the cost of medicine and drugs, this could be beneficial for United Health. Apparently there is leadership turmoil, so I don't follow this company that well. Cybersecurity incident, and that's right, one of the CEOs of the company was killed in December. And also regulatory scrutiny and legal challenges. So all these things have combined to see the share price drop from $600 down to around $270. Yeah, the low was $249. Does look like the share price has bounced a little bit. A lot of volatility in that. So the question becomes, is there value in this company right now? Has the market panicked? I reckon maybe so. I reckon this could be a case where the market is overly panicking. And you see this a lot. The market does over panic. So when the market's feeling good about a company, they will overpay. And when the market's feeling crap about a company, they will oversell, I suppose is a good way to put it. So I think there's probably some good value with United Health. So thank you for that, Archie McCall. Okay. Oh, Ben Hutchison, what's the flaw in this reasoning? Talking about copper or the relationship between copper and price, which I haven't really thought about. There is a relationship between copper and the state of the economy. That's why it's called Dr. Copper. There is a historical ratio between the price of gold and the price of copper. And I did not know that. The ratio is particularly high for gold at the moment. If we believe in mean reversion, and I do believe in mean reversion if there is a relationship, a really sound relationship. In fact, mean reversion works most of the time. So, for instance, CBA right now has a P ratio of 30, and mean reversion will kick in eventually, and the P ratio will go back to the mean, which is probably 15. So, the share price of CBA could halve from here. And in fact, if we see a swinging in the other direction, P ratio of CBA could go to, say, 10 or 12. Doesn't happen very often. And if I did see this P ratio of CBA go to 10 or 12, that's a buy, which is because there's good value. Anyway, if we believe in mean reversion, then the ratio should trend towards a longer-term average. Therefore, we should all buy copper stocks. Okay, if following at home, you can substitute your favorite commodity for copper, iron, coal, mud without breaking the argument. Oh, you're saying the ratio of gold to anything is high for everything. So gold, you're saying, in a way, gold is overvalued right now. And either gold has to pull back, the price of gold has to pull back, or the price of all these other commodities have to go on runs. Yeah, that could be true. Fishbowl says, check out Perenti breaking out. They did have released, I've noticed. Oh, this is where I have to touch my keyboard. There we go. I've noticed Perenti have released a few nice little, what do you call it? Share price up 6%. A few contract wins recently. Yeah, in fact, in the last week, 1 billion contracts, 500 million contract. And I've mentioned just one contract in itself may not mean a lot, but when you have a few in a row like this, the share price will go silly. Maybe not silly, but I was trading Perenti, then I got out, and the share price, I think, is looking pretty good right now. Now, yeah, this chart is looking really good. Look at that, yeah. So I sold out somewhere here. That's right, I sold out because of that. This was a false trend killer event on the 24th of February. So the market, for some reason, didn't like their results. I didn't know why, but I listened to the market. But what I should have done was just stay steady, because the next day share price popped up. Although during April, the share price did pull back. But nice support at $1.16. Share price has gone higher since then. So good week for Perenti. In fact, the share price in the week is up 14%. And in fact, if you have a look at the weekly chart, even the weekly chart looks pretty nice as well. So Perenti on a bit of a tear. And yeah, Fishbowl was right. Oh, I'm going to do a standalone video on Mace552's comment here. You mentioned if you do want to own Technology Run 1 right now, you do have to pay a little bit of a premium. It's not cheap, but wouldn't it look cheap in 5 years' time when it most likely doubles with the way things are going in most likely well? The one thing I will say before I do the standalone video, and this will be a video I'm going to bank, is Technology One could double everything and the share price could actually go backwards, because there are two ways a share price can increase or decrease. Well, actually, we'll just talk about increase. There are two ways a share price can increase: financial expansion and multiple expansion. But a company could could have financial expansion and the share price could go backwards if the PE ratio goes down. So a company could have financial expansion plus multiple contraction and the share price could fall. So right now, the market is willing to pay a premium for Technology One. Question is, in 5 years' time, is the market still willing to pay a premium for this company? And if it's not, the share price actually could fall, even if the company doubles their profit and all that sort of thing. Do I think that's going to happen? Probably not, but that is something you have to be wary of when a company is trading on a high PE ratio. Is the market going to be willing to trade this company at a PE ratio similar to this in the next 5 years? It's why CBA is really expensive now, and this is why I would not buy CBA right now, because it has never traded on a PE ratio of 30. It's doing that right now. So more than likely, just based on probability, share price will drop because financial expansion won't happen. So what's going to happen now? You might see a little bit of multiple expansion, but more than likely, multiple contraction will send the share price of CBA down. So I'll do a standalone video on this because I do want to talk a little bit more about that. Ed Cavey, hey Kneppy, would love to see your cover 3-day and IPG. They both look like they are undervalued and positioned for a nice run. Thanks. Okay, 3DA, which is this? Amaero or something? Amaero. And the other one was IPD Group. I'm assuming you mean IPD Group. Yeah. Okay, so I don't know much about Amaero. So if I don't know much about a company, first thing I would do is just put it into here, into FinChat, and markup is almost $200 million. Enterprise value similar, so not much debt. Nice growth in revenue over the last 3 years, 49.6%. Does not look like the company is profitable. So first thing I like to do is just have a look at revenue. And look, revenue is going sideways. This is 1 year revenue. Revenue is going sideways until the last year. And I'm wondering if this company has Appendix 3Ds. Not 3Ds, 4Cs. What am I doing? And they do. So they signed a long-term exclusive 35 million supply agreement. They also listing rule compliance matters. That's interesting, but it's not price sensitive. So I always, for these type of companies, I always have a look at the cash flow first. So receipts of customers in the last quarter, 588,000, and operating cash flow negative 5.763 million. So this is probably why I don't know much about this company, because they're still burning through a lot of cash. Now, they might have a lot of promise in the future, They might increase their receipts, but I need to see that happen. That's just my risk profile. I need to see proof of concept here for this company. It might happen, and if you're more of a risk taker than I am right now, then maybe this is a good company. But I need to see a little bit more from this company for me to get excited. That's just me. Now, IPD Group is a little bit different because I do own this company. I will say that right now. I do own IPD Group, and the chart does not look good. We'll have a look at the charts of both these companies in a second. The chart does not look good for IPD Group, but I do think it's looking cheap or good value at least. This company has only been listed for 3 years. 3 years. Yeah, 3 years, maybe 4 years. I'm trying to remember when they listed. It was either 2020 or 2021. So maybe even 5 years. No, I don't think it was 5 years. 4 years. Anyway, so we don't have a lot of, or we don't have like 10 years of history or even 5 years of history because they've been listed less than that. But over the last 3 years, revenue 33.2% higher per year. Earnings per share 27.4% per year higher. Gross margins 35.1%, like that for this type of company. Operating margins 11.6%. I think there is a room to grow there. We don't have 5-year averages for return on equity and return on invested capital because the company has not been around for 5 years. I don't care about the dividend yield or payout. Payout's good at 50%. I would like that to be a little bit lower, but that's okay. P ratio 14.8. That's what is intriguing me about this company. The P ratio is at 14.8, particularly because it's still growing. So the market might be anticipating no growth in revenue or earnings over the next few years. And if the market is wrong, this is cheap. Now, the other thing I'd like to look at, we'll have a look at return on equity and return on invested capital, because I don't know if I could call this company high quality just yet. I just need a little bit more proof. But return on equity and return on invested capital have been above 15% over the last 3 or so years. So that's good. I don't want to see it lowering any more than this, but it's on the right trajectory, on the right trend. And they're in electrification, that sort of thing. So distributes electrical equipment in Australia. So it's what about electric vehicle solutions, industrial communication, power monitoring. So they're in the right space, in my opinion, because we do have to overhaul our electrical infrastructure in this country. Anyway, so let's have a little chart for both companies. We'll start with 3DA. I don't know anything about this chart. It must not look all that flash hot. Yeah, it doesn't look flash hot. It was looking good between July 2023 and May 2024. It was going on a nice run then, but the share price is in a downtrend right now. So the only way I would own Amaero is if it was a trade, but even then, I'd be a little bit nervous about this company. Okay, so on to IPD Group. So this is where I'll show you when I bought. There it is. There's me buying, and it was in February 2022. So just after they listed, I bought. And the whole reason I bought is because they released must have been either a profit upgrade or a trading update, 7th of February, or something like that. So I bought $1.44, and then look at that beautiful uptrend from there all the way through. So this was the first sign of weakness, was in late 2023. Share price went down a bit, then recovered. But since then, the share price has gone sideways. And if you have a look right now, the share price is struggling. In fact, you could say the share price of this company is in a downtrend. And yes, that's probably the little negative thing about this company, is just the chart looks pretty crap right now, but valuation. And if the market is wrong, this company is probably good value. But I'm willing to just maintain my position. So I was trading this, and when the trade went against me, I decided not to sell out completely. I decided to maintain half my holding and just trade the rest of the money in other companies. So that is what I'm doing. Okay. Someone just tried to call me, and they want to know about the moving quote, which I've already planned like 6-7 days ago. They're a little bit late. Okay, so that's IPD Group. So if you are a value investor, this could be a company for you. And all it takes, now, I was going to say that, what I'd like to see right now is the share price to go sideways to eliminate all those shareholders who are stuck, who think this company is crap company because share price has gone down from when they bought, and we need to see those shareholders sell. So that's the benefit of a company share price going sideways for a while, because they become bored, they sell out, and when the company might release something really positive, the share price takes off. Share price could take off, and you don't have their shareholders are no longer on the registry. It's like a new group of shareholders, and that's when the share price could go on a really good run. But I do think there's an argument shares in this company are looking really good value at current levels. Okay, that's one. I've already answered that. VB Ed, regarding New Farm, I like you avoid any company involved in agriculture. The only agriculture company I dabble in is the Rural Funds Group, RFF. It never fails in delivering high yield dividends paid every quarter. So even with RFF, I am adverse. So no matter the company, I'm adverse to holding a company like this for the long term. Now, when it comes to rural funds, I did have a look at this not that long ago, because the share price had got down to a really good level, interesting level, a nice dividend yield, as you said. So that nice level was about $1.62. And the reason that's a nice level is if you go back to 2019, there was a short report on this company, and that's why the share price dropped a fair bit. Share price fell to these levels on that short report. The share price then rallied up to about $3.20, and now it's down to $1.76. So there could be maybe some value in this company at these levels, maybe. But it's an agricultural company, and I just don't like these companies. Although, in saying that, from when they listed back in 2014 all the way through to that short report, the share price was on a really nice tear. But yeah, this is the sort of the chart you might see for a non-high quality company. But definitely can see the attractiveness of that. And I do think they're a diversified agriculture company. And I think that's the way to go with agriculture, is being really diversified all around the world. Costa Group was trying to do that, but they weren't diversified enough. And they're no longer on the ASX. Ben Hutchison's, the dodgy attempt to delist VMoto, company I don't care anything about. The ASX-listed electric motorcycle manufacturer was narrowly voted down by shareholders today. Good work, shareholders. Looked like a case of management and friends putting their interest ahead of other shareholders. That's really good news, because I don't like when companies delist, unless it's for good reasons. I'm not the biggest fan of this company, VMoto. I looked at this company probably 10 years ago. VMoto. The only thing I think about when it comes to VMoto is they sell little scooters and sort of stuff like that. Results of meetings, that must have been it. Did they give a reason why they were delisting, or they wanted to delist? I wonder if they just mentioned, oh, the company is undervalued, which all companies do, or most companies do. There we go. Company intends to delist from ASX 16th of December. I'm just going to open this up just to see. I probably went through this when they did it, because whenever I see these announcements, I always have a look, and they should always give reasons. There we go. Public share price does not reflect true value. Low liquidity, maybe, but I just hate when it says public share price does not reflect true value. Well, the problem is your company itself, in my opinion. Anyway, typically when they say that and they go through with this attention, share price drops a lot. And the whole reason share price drops a lot is because private companies are valued much lower than publicly listed companies, because access to capital is much harder. Yeah, it's just weird. They say this, share price does not reflect true value, and then share price just plummets. And I'm wondering if the share price plummeted on this day for VMoto, 16th of December. Let's have a look. 16th of December, share price dropped. In fact, it dropped the next day at 33%, and then the next day after that, 15%. So share price went from above 10 cents to 5.3 cents. Share price halved because of their intentions to delist because they were undervalued. It's ridiculous. It's stupid. Stupid. By the way, share price did get back up. No, it didn't. I was going to say share price got back up to 10 cents, but a lot of volatility in this particular chart. Anyway, so looks like the shareholder said, get lost, be off, scram away. And 25%, oh, okay. 25% of the votes cast on Resolution 1 were against the adoption of the 2024 Remuneration Report, which constitutes a first strike for the purposes of the Act. Good work. Okay, here we go. Removal from the ASX official list, 4 against, not carried. Yes, good work, not carried. Fantastic. Very happy with that. And let's have a look at the chart. So, yeah, I first looked at this company many years ago. And, yeah, the company's done nothing since then. That's over 10 years ago. And you can just see that by the chart. So this company does go through little spurts of higher enthusiasm, but they don't last. And right now, it's at the lower point. And all the company has to do is become profitable on a consistent basis, cash flow positive on a consistent basis, and grow. And then the company will be priced at an agreeable, good level. So if you have a look at this history of this company, just have a look at the financials, total revenue. It's just all over the place. Nice growth for 2018 to 2022, and then dropping. Gross margins. Gross margins are rising. That's a good sign. What about operating margins? Oh, operating margins got to a peak of about 10%, had been dropping recently. And also profit. Well, let's have a look at profit. How many years have been profitable? Well, they did get to $10 million of profit in 2022. Now it's negative. So you could probably look at these financial metrics and compare it to the chart. So the share price was going to run. That was just around before these really good financial years for the company. And then everything's got turned negative the last few years. Okay, is that the last? That is all I have for today's answer and reply video. I was thinking and hoping it would go for about 1 hour long. If you do have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.